We're pleased to have Ralph Simon, Vice President for Investment Services, on with us today and presenting for us. If you have any questions for Ralph while we are going through our webinar today, please type them in on the chat feature, or at the bottom of the screen, you also got a Q&A button. You can type questions in either of those places. I'll keep track of those questions, God willing, and I'm able to stay on, and we will we'll have a little Q&A time at the end for Ralph. But we are, I tell you what, because of this internet, Ralph, I am just going to pray and then let you take over and see if I can get my tech fixed up here. So let's go ahead and start with a word of prayer. Gracious Lord, our Heavenly Father, we give you thanks this day for the opportunity to be gathered together to see how we can best steward your resources that you give to us. And we pray, oh Lord, that we are always faithful in what we do and how we invest and the ways that we fund our ministries and our missions. And yet, Lord, we know there's always things we can do better. And we give you thanks for the opportunity to learn and grow together today. We pray your blessing be upon our time and all who are here in Jesus' name. Amen. All righty, Ralph, you take it away.
Thank you very much, Pastor Todd. Also, a big thank you to Deaconess Sandy Bowers, who coordinated the meeting rooms and our publications, publicity information on this, and really appreciate her help here in LCMS ministry support. Also, a big thank you to all of our ministry partners who are listening live or maybe through a future recording of this. It's great that we have this technology to file this to be accessible at persons' conveniences. So as Pastor Todd said, I am Ralph Simon. I'm Vice President of Investment Services for the LCMS Foundation. I've been in this position for almost 9 years. And before that, I was at Concordia Plan Services and covered a lot of the Western districts with benefits and education services in that regard. So our topic today is talking about investment services and why it's important to be planning for tomorrow. So in terms of planning for your ministry's future, if there's assets available or if there's future assets available from generous Lutherans, as our gift planning department would say, when their gifts mature and they go to heaven, that some of their gifts are returned to ministries for future generations. And so how to plan for tomorrow is there needs to be a physical decision to decide to focus on the long term. Ministries should think of investing over decades. You don't want your funds to be diminished by inflation, and you want to be strategic with how you invest your funds. So in our situation, the minimum to open an investment account, and again, we only work with LCMS ministries, but the minimum to open an investment account is presently only $5,000. So money sitting at the bank, keep emergency money at the bank, but money that can be allocated for the next generation to have resources, let's look at long-term investments. And this is an example why. Mentioned to you that I am a member of Historic Trinity in downtown St. Louis. Let me introduce you to the 8th grade confirmation class of 1905. And for those who are LCMS history buffs, the pastor on the right side of the confirmation class is Pastor Otto Hanser. And he was a longtime pastor at Trinity Soulard. Here in downtown St. Louis, pastor over 30 years. But if these children were to come back to us today, one of the questions of these 43 in this picture would say, what happened to my school? Because there wasn't any endowment started, and St. Louis, not unique to what happened in our middle America cities like Detroit, Memphis, Orlando, is that with the progress of sprawl, partially the automobile caused, none of these kids are driving, and the highway system divided our community at Trinity. And so the school, just exactly 99 years later, had to close. And so when this picture was taken, there was approximately 1,800 in worship on a week. There was either a Monday night or a Tuesday evening service, as well as I believe 3 services on Sundays. But had an endowment been started with even a small amount of money, as I'm sure it wasn't ever a very wealthy congregation, although there was some very, very generous hearts there. All the facilities were usually paid for in cash when they were done, when they built the sanctuaries and the school buildings. And actually, back in the 1860s, 3 members of Trinity came up with the resources to begin Concordia Publishing House. So this is a key portion of our topic today, is as I travel the country, I realize that ministries really have millions, perhaps hundreds of millions of dollars sitting in corner banks, paralyzed with the idea that we need to keep this money safe. Well, money left at the corner bank has really been anything but safe. It's just a very silent erosion. This graph is covering a period of time of 28 years. So the left bar graph is 1994. It's illustrating what you could have earned if you had $100,000 in a savings account. So you see in 1994, you would have earned close to $4,000 in income. The blue dashed line is how much money you needed to generate to beat the rate of inflation. So you'll see, beginning about 15 years ago, as interest rates decline, that the rate of inflation is far greater than what you could possibly earn at a bank. And in fact, in 2022, $100,000 in the bank would have generated approximately $80 in income. But that top blue line that you might see is what you needed to generate to stay even with inflation, was $6,436. So really, money at the bank was a guaranteed loss in terms of purchasing power. So we often focus on the risk of principal, but another big risk is purchasing power. There's also interest rate risk. There's systemic risk when there's everything goes to heck in a handbasket, you might say. But this is a very important thing to consider, is there's money that's been parked at the bank for years, and many ministries' cases, decades, has actually shrunk the purchasing power considerably. And so you need to work with asset classes that we'll talk about that can do better than just the asset class of cash, which is what's at the bank. So a little bit of going back to our finance classes, the rule of 72 is how long it takes money to double at a certain rate of interest. So following those examples there is, if you had an investment account earning 0.5%, which would have been common in 2021 and 22. If you're earning 0.5%, it would take 144 years to double that money. 144 years. If you're earning 3%, it would take 24 years to double that money. And that's about what the rate might be at some institutions here in 2023. Still, if you're earning 5%, it's going to take 14 years, 14 and a half years nearly, to double that money. So the bottom line is we need to focus on stewardship of those assets. This is a busy slide, so I apologize for that, but it's packed with a whole lot of information. Each color on this chart represents a different asset class. So if we just look down the left column, which is titled 2008, I'll give you what all those acronyms mean. This fixed income would be the bond fund in America. Cash, well, that's what we've been talking about with money at the bank. Next one is asset allocation. That's an example of if you had a 60-40 portfolio of stocks and bonds, what it would have accumulated or how it would have fluctuated over time. The blue box is high yield bonds. Those are bonds in the United States that don't have a great credit rating. Orange is small companies in the United States. Green is world commodities. Think of gold, silver, oil, other corn, beans type food commodities. The green is United States large caps. Blue is real estate investment trusts in the United States. The gray area is international developed markets. That would be large companies like, or countries like Germany or England. And then the bright purple is international emerging markets. EM is emerging markets. So an example of emerging markets would be Mexico or Brazil. So what this chart shows you over a period of time, with the exception of 2018, cash was always behind other asset classes. Now, again, when you need to put money aside for, just like we do at home, money aside for a refrigerator or insurance deductible, cash is the right place for it. But you see all these other asset classes historically have far outperformed cash, except when you look at a very short period of time, like maybe 2008, when that was the banking crisis. And in 2022, cash did okay. You remember that was just a few months ago. But you see the leader there was commodities. Well, what happened with oil and natural gas? And so that was the only asset class that did very well, was commodities in 2022. All the rest of it that we're dealing with in our everyday lives certainly didn't. But what's helpful to see in this graph is that line, and this is not representative of anything the LCMS Foundation does. This is talking about US markets in general, or world markets in general, is that asset allocation line, again, is a 60-40 portfolio. And so a blend of all those different asset classes over time can give you some great diversification. So when one is not doing well, another is, and gives you some great opportunities for long-term growth. This, again, is a graph. These two graphs were put together, by the way. One of our investment managers is JP Morgan, and they do some excellent financial reporting. So this, again, is talking in general of the United States. Let's look at the far right boxes there, where it says 20-year rolling. So in green is United States stocks markets. In blue is the US bond market. In gray is a blend of 50-50 of those two markets. So again, looking at that right box, this is illustrating 72 years of rolling history. So think, 1959 to 1979, 20 years. Any rolling 20-year period of time, how assets would have performed. And you can see that the 50-50 portfolio in that 20-year rolling period of time, over 72 years, the average total annual return is 14%. Or excuse me, the best year was 14%. The worst year was 5%. And then if you go just to the group on the left of that, the 10-year rolling period of time, again, think of a 10-year rolling period of time over the last 72 years, from 1950 to 1960, or 1970 to 1980. The gray area of a 50-50 portfolio, the best it might have done in any rolling 10-year period was 16%. And the worst it would have done is 2%. And if you go to the left again, you'll see the 5-year rolling period. Any 5-year rolling period of continuous time in the 72-year period, which ended just in December, a blended portfolio of 50-50 stocks and bonds, the best year, 5-year period would have done 21%. And the very worst 5-year period would have done 1%. So this is the point of how ministries live. You know, on this earth, we feel very blessed if we make it to 70 or even 80. A co-worker of mine's dad just passed away at the age of 97. But you know what? My church is 183 years old. And I know many congregations that many of you are affiliated with are over 100 years old. So different than how we think about planning for retirement or planning for children's education, ministries are going to live a lot longer, God willing. And so having resources invested for them to work with is a real blessing for future unknown generations. So the LCMS Foundation can help. We are Lutherans dedicated to ministry success with investing. We're highly attentive to your ministry goals. We understand it. We are Lutherans, and we are created by Synod. We offer robust and diversified investment options that make it pretty simple for the investment committee or the finance committee, church committee, who might not have a lot of skill set at times with investment services. So we were created by Synod in 1958 at the Synod Convention. President Bankin at that time presented a letter to many of the congregation. Here's a side of it. But it's important to know that we were created for Synod entities, and that's all we work with. There's a lot of organizations out there in the marketplace that have the word Lutheran in their name. You can probably think of some of them. I'm not going to name them. But they use the word Lutheran because it's not copyrighted. They are probably targeting Lutherans and have every intention of helping. We're a little bit different in that we actually were created by Synod for this purpose. As these other corporations of Synod. The seminary, of course, 1839, Concordia Publishing House, 1869, Concordia Plan Services, thank Lord for benefits, health insurance and disability and retirement. Concordia Plans in 1937. LCMS Foundation, 1958, as I mentioned, and the Lutheran Church Extension Fund, LCEF, in 78. Let me pause there, is that often we get asked the question, how are you different from LCEF? Well, LCEF provides a very important ministry to all LCMS congregations in that they offer interest on deposits. And with those deposits, they lend it out to churches and schools for expansion and renovations and building. So the extension fund is working with the asset class of cash, pay interest on deposits, lend it out. The LCMS Foundation is not intentionally working with cash. We are working with the asset classes similar to what was on that chart earlier, and I'll tell you about them more detail, but basically stock and bonds markets, long-term investing. And again, basically, although it is a complicated subject, we make it very simple in our options for ministries to work with and our very low $5,000 minimum to open an investment account. So our focus is 2 points. We provide plan giving services for LCMS members and ministries. Many of you are affiliated with one of the LCMS gift counselors that are around the country. There's 21 full-time counselors. Most of them are working with a district area or a geographical area. And then there's also 2 of our gift planners are working just with the membership of the Lutheran Women's Missionary League, LWML. And then we offer our investment services into assets just to Lutheran ministries. So it could be RSOs, the universities, the seminaries, and your congregation. So a little bit about our financial credentials. Again, I mentioned that we were founded by Synod, is we're providing these investment services to nearly 600 different ministries and also 5,000 different donor trust accounts. So the donor trust accounts are ones that were created either during a donor's lifetime, more often at the donor's death, and that we are the administrator on their charitable remainder trust or the different things. We're able to focus on low fees, a couple different ways that we're different than other investments like mutual funds. And of course, we have a long-term approach. As I mentioned, ministries live a lot longer and don't have the same constraints of changes like people do. You know, people have births and marriages and deaths and divorces and retirements. Ministries are here to share the gospel. And that hasn't really changed for over 2,000 years. So in our investment options, we focus on long-term perspective. This has got a complicated acronym on it known as NACUBO on this slide. And NACUBO stands for the National Association of College and University Business Officers. This slide looks like it's old because it's from mid-2021, but it takes a while to get this data. Because if you look at 720 of the higher education endowments as tracked by their organization, NACUBO, as of June of 21, our aggressive balance fund, which I'll give you more information about and certainly be glad to talk with your investment committee about. Our aggressive balance fund has beat the average return of the NACUBO funds in 3-year returns, 5-year returns, and 10-year returns. Those are average annual returns for that period of time ending June 21. And you'll see that illustrated in the bar graphs, the LCMS Foundation in green, the average NACUBO investment in blue. We can be very proud of those returns. A significant amount of those returns is not just manager selections and returns. A lot of it also has to do with low expenses. Low expenses adds to total return. Here's another graph illustrating our long-term investment report. Is again, funds we'll talk about more in detail in a minute, is our aggressive balance in green and our moderate balance in blue. This is a period of time over the last 15 years. And you'll see how a $10,000 investment in 2007, how it would have fluctuated over time with the jagged lines. You'll see that banking crisis in 2008 and 9, yes, funds went down considerably. As you continue in the graph to the left, you'll see the beginning of the downturn in 22. And you also see the lockdown in 20, which seemed horrible when it happened, but you see it wasn't anywhere near as rough as the federal banking crisis is in 2008 and 2009. The orange line represents what you would have if you had money at the bank. It follows the 90-day treasury bills. And so a $10,000 investment in 2007 would have not had any risk or fluctuation to it, but by the end of 20, or when we reported this in April of 22, that $10,000 would have grown to about $11,500. Where you can see, even with the downturn beginning in 22, in our aggressive balance fund, it still would be worth around $23,000. And then the moderate balance fund would have been worth about $21,000. So again, long-term investing works. I mentioned a little bit about our fees. We have an investment advisor that helps us. They formerly were known as New England Pension Consultants. NEPC is their corporate name. And they don't manage any money for us, but they help monitor, select, and review the managers that do. That's a layer of safety for ministries, that we have an investment consultant that doesn't handle money. When I'm talking about low fees, that's because NEPC also works with Concordia Plan Services for investment advice. So where I'm speaking to you from here in St. Louis in the International Center, you've got two organizations under one roof, Concordia Plan Services and the LCMS Foundation combined have over $8 billion in assets. A lot of the Concordia plans, of course, is the pension plan, but also reserves for disability and the health insurance. So NEPC helps both Concordia Plan Services and the LCMS Foundation with strategic asset allocations, how much we own of this and that. The different fund managers and money managers have expectations. If they don't meet expectations, sometimes they're replaced. And then they also help us with our investment policy statement. And here's a copy of that, which of course I'll be glad to send to you. All my contact information will be available through Rural Small Town Ministries website, as well as on the slides here. So some investment oversight. I mentioned that we have NEPC as our investment advisor. Our key partners would be considered our member organizations, Concordia Plans, Concordia Publishing House, the seminaries, the universities, all hear from our investment advisor and auditor. Daily happening here at the Synod building is our staff activity with managing money that's coming in or money that's going out. There's a lot of daily activity in that. Monthly, we have a staff investment committee meeting that if I'm in town, I sit in on. And the staff investment committee reviews the monthly performance as well as 1 year, 3 year, 5 year, and 10-year performance of every one of our managers individually and how they blend into our asset class funds. Quarterly, there's a board investment committee that reviews all the performances, and we discuss maybe any changes to the allocations that the managers have, and in some cases replace managers who we think we can find someone that's doing a better job. And that doesn't happen real often, but it has happened twice in the last 30 months where we replaced 2 managers. Annually, these managers are in person with us. COVID changed a little bit of that and we had to do Zooms, but a lot of the East Coast money managers, they're still not allowed to travel. But we do in-person visits with the fund managers when we can. We be sure that they're adhering to our investment policy. And then available in hard copy or available on our website is an audit. And that's done by Armanino. And we also do, for the accountants in the room, a SOC 1 report. That's SOC-1 report. And a SOC 1 report is more than just a regular audit in that it audits your procedures, how you're handling money, deposits, withdrawals. A few years ago, the hot button with the SOC 1 report is how we might operate if we were not able to work at the building because of a terrorism attack on a religious institution. Well, that plan had to be implemented with the lockdown. We always had a skeleton crew here during the COVID lockdown to work with deposits and withdrawals, but we were all able to work from home during that period of time, and of course got more proficient with these type of Zoom and Microsoft Teams meetings. So our investment philosophy is to be sure that our portfolios are well diversified. We have a long-term perspective. We're fully invested. We don't intentionally have any money in cash. We work with the traditional asset classes. Wall Street would say we have a pretty vanilla not too exciting blend of funds. No hedge funds or private equity. We have a fundamental approach to our investments. We use a mix of both active and passive fund management. That's a hot button today where you're talking about index investing. That's a synonymous term with passive investing. And we use a combination of both. Passive investing or index investing is very, very cheap because it's basically computerized trading. There's no salaries and benefits involved. But we also expect our active managers to exceed the market, which wouldn't be possible with just passive management. And then I mentioned we're able to focus on low fees. So we don't really get into some of the risky things that Wall Street companies do. Our investment style is pretty vanilla. We don't have any high risk investments like hedge funds or commodities or precious metals, private equity, or cryptocurrencies, the buzzword of the day. Let me introduce you to Elaine Hertwick. She's the pastor's wife at Mount Huldah in Cole Camp, Missouri. And the steeple workers were working on the steeple and she asked them to give her a ride. So I thought this was kind of a fun slide to say that she might be a little bit of more of a risk taker than a typical Lutheran. And I would expect that Elaine Hertwig wouldn't be too shy on investing in hedge funds or maybe even cryptocurrencies, as she was having fun a little higher than the utility poles hanging from a crane. These are our actual fund managers that we're working with. Two new kids on the block are Siegel Bryant, Hamel, and Global Alpha in the last 30 months. They replaced managers of similar style that were underperforming for a period of time. We give everybody some slack. There's going to be times when your wagon's not as fast as the other, but when it's persistent, then it's time to move on. Again, some of these managers are passive managers, meaning index or just riding the market. And some of these managers are actually active managers. Each one of them has a little niche market or part of the asset class that we choose them to work with. They have part of that asset class. So getting down to exactly what are our funds, we have a group of funds that are called our preference funds, and they are the building blocks of which everything else is built. Is the domestic equity is stocks traded in the United States. Those stocks could be small, medium, or large. International equity is stocks traded around the globe, not in the United States. They could be emerging markets. They could be developed markets. And then we work with the asset class of core bonds, which is high quality government, US government and government agencies with a good rating. And then we also work with high yield bonds, which is bonds of US companies that quite frankly don't have a great credit rating. But they would still be common names to you like AutoZone, Ford, General Motors. They just have to borrow at a higher rate because they're don't have a great credit rating. So of these four asset classes that we work with, ministries could choose to pick an asset class to invest in. These are called our preference funds. But in guidance with NEPC, we build what we call our standard funds. So in the middle of the page, you see the moderate balance fund. And towards the bottom of the middle of the page, you see the blend of those preference funds that are in it. 40% core bonds, 30% domestic equity, 20% international equity, and 10% high yield bonds. It's basically a 50-50 portfolio. The neat thing for our ministries is we rebalance back to that 50-50 portfolio at the end of each month with no work on the ministry's part and at no additional charges to the ministry. To the right of center is the aggressive balance fund. which again is using all four of those asset classes. Domestic equity, 45%, 30% international equity, 20% core bonds, and 5% high yield. And then the great thing is that it is rebalanced back to those percentages at the end of each month. What this means in comparison to mutual funds, that kind of smells like mutual funds, is these funds do not have the expenses that mutual funds would have in them. We also don't have in the portfolio, you can see there in the percentages, any cash. Sometimes we do have 1% in cash because it's administratively impossible to do all the ins and outs on a $100 million in a 30-day period. But because our funds are fully invested and because we only work with LCMS ministries, we only transact business at the end of the month. So all deposits are credited, all withdrawals are processed for our ministry accounts at the end of the month. And so different than mutual funds is we don't own the software or employ all the people to do those daily calculations for account values. So that works very well for our ministries to choose one of these funds. Earlier, I showed you the graph of the moderate balance fund and the aggressive balance fund and its fluctuations over time. Our current performance numbers would show you that our 3, 5, and 10-year performance of those two, the moderate balance and aggressive balance funds, are exceeding their benchmarks. And that's information I can send to you, or it's available on our website. Feel free to send me an email, question, or call me. So the LCMS Foundation has a service fee, and that is what it costs us to run the organization. The printed materials that we can send you, our marketing costs, my salary, is that on the first $1 million that a ministry has invested, there's 55 basis points or 0.5%, 0.55, whichever way you want to say it, on the first $1 million. And that's an annual fee. So if you're getting quarterly statements, you'll see 1/4 of 0.55 of the fee deducted on a quarterly basis. The nice thing for the typical congregation is this is the same fee sheet that our seminaries and universities have that have tens of millions of dollars on deposit. We're using all that purchasing power of the LCMS organization, not just the purchasing power of Holy Cross or our Redeemer or Trinity. So those are the fees that are involved. And then a little bit about how we're different, because I usually get asked that question as well, how are you different from the Wells Fargos and the Edward Joneses? Is we only work with LCMS ministries. We don't work with the people in the pews for investing. We do with gift planning. I mentioned that with Concordia Plan Services, our efficiencies and breakpoints and expenses are realized by all ministries linked together, not just a single ministry's assets that they might have under management. We don't trade daily. All securities and purchases and redemptions are at the last day of the month. We're not securities regulated, so we do not provide investment advice. But those standard funds are built with ministry in mind. Just choose one of those to work with. We focus on a long-term horizon with our fund expectations that our fund managers meet or beat the benchmarks they are evaluated by. We have a detailed statement of policy and objectives. That's covered in this booklet. And then to make it a little bit easier, our marketing people turn that into a pretty brochure that covers all those investment policies and objectives and graphics in a more understandable method. Wall Street would call those standard funds that I talked about asset allocation models, similar to 401ks and 403bs, where it might have an asset allocation model in it based on age. Ours are based on the allocation of assets. We annually report to Synod leadership. So your district presidents sit in on a presentation at the fall conference from our presentation from our auditors to hear how we're doing. And also hear from NEPC, our investment advisor. Today, with the fluctuations we've had in the market in the last 3 years, a lot of ministries, if they're investing a large sum of money, they're concerned about market fluctuations. Well, it's not so important when you get invested or when you put the money in the market. It's really how long you're in the market. But a technique that can help you sleep a little bit better at night is called dollar cost averaging. And so if a ministry is investing $50,000 or more into either a new account or an existing account, we will let you dollar cost average that in over 6 months or 12 months. So what that means is we receive the lump sum of money, and then we put 1/6, 1/6, 1/6 over 6 months into the actual investment, or over 12 months if they want to go that long. We do that at no additional cost. So equal portions of the deposit are invested monthly. There's no administration charges on that money while it's sitting idle. The administration charges, that 0.55, is only on invested accounts. But that way, doesn't guarantee a better rate of return, but it can make the treasurer sleep a little bit better at night if you were to invest a large sum in March and then there's a 10% correction in April, which would be pretty normal. But when you look at the long term, you'll see the best returns is when you look at these increments of 5 years, as some of those graphs illustrated earlier. And this is why you need to do that with your ministries, is, as my friend in accounting said, numbers are hard, but days go slow and years go fast. Who would have thought in 1905 that 100 years later, the mother church, Trinity, would have been closing the grade school? So you should know that, all our investments have some risks, are up and down. They're not insured by the FDIC. They can lose value. When you're measuring them in short terms, they probably can fluctuate a lot. But when you look at increments of 5 and 10 years, much better returns. There's my contact information. Ralph.simon@lfnd.org is the best way to reach me. And that's also available on our website. And I'm sure that Todd and Deaconess Sandy could help us get a hold of me. So Todd, I'm going to open it up to questions.
Hey folks, get your questions in on that Q&A feature or down in the chat feature. That'd be great. Any questions you have for Ralph? We don't have any left. That was great information, Ralph. Thank you so much. I think so often it becomes rather confusing to folks when they think about these long-term investment strategies because there's so much information coming at everybody. I think the beauty of working with the LCMS Foundation is that it is LCMS and it is out for the greater good of the church. Tom just asked, can we get a copy of the slides? We do have a copy that we can get to you, Tom. If you would email us, Sandy, if you'd throw out the RSTM email, but rstm@lcms.org, rstm@lcms.org, we'd be happy to get you a copy of that, or shoot Ralph a message and he will get that copy out to you. One quick question for me, Ralph, is simply so we were talking before we went live. I'm in a rural parish in northeast Nebraska. I've got a fairly substantial amount of money that is given to the church. And, originally it's invested in a couple of CDs, but we're needing to look at something else. How do we get involved with the foundation and where do we go? What's our first steps?
I would suggest that church council appoint a task force. Church council and the voters assembly is way too big a group to make good decisions on that type. So
amen.
So have church council appoint a task force of anywhere between 3 to 5 people to make a recommendation to council on what should be done with the money that can be allocated for long-term. And the typical person you'd want to put on that task force would be the retired attorney, CPA, or registered representative, Wall Street person or something, maybe even a State Farm guy, or woman. That they would be, great candidates to be involved. And then I would be glad to have a Zoom discussion with them, do a different presentation that we just went through today, focusing on their questions and interacting them. And if need be, I'll be glad to travel and be face to face. But a lot of organizations are very content to do a high level meeting over Zoom. And then once the organization task force or whatever has resolved what should be done, they make a recommendation to church council. And then sometimes I come back in for conversation with church council. There's one form that needs to be filled out to open an account. It's basically 4 pages long. It's where you tell us who our contact is and how much you want to invest and where you want it to be invested. And do you want us to send any automatic distributions out of it, or just let it accumulate and take occasional withdrawals as desired? And so once that form is filled out and then the money is on deposit, the account is opened, and the ministry then is assigned a trust administrator, one of our key employees here at the International Center. And that trust administrator then is who helps them with additional deposits or withdrawals, or any questions on doing dollar cost averaging on the new gift that's been received and things like that.
Awesome. That's great. So, and you had mentioned a minimum investment of $5,000. Kind of talk about that just a little bit. What might, what kind of parameters are we looking at for a typical congregation?
As you mentioned in our earlier discussion, if I can pick on you a little bit.
Please do.
Got money sitting in a CD. And
yeah.
So if all that money is likely to be consumed by ministry needs in the next 3 years, the bank's probably the right place for it. But if some of that money or a lot of that money can be put aside for your replacement or for the DCE in the future, let's put that in a long-term investment that's going to outpace inflation. And so that's what our funds would give you the opportunity to do some longer term thinking. And so if you've got $50,000 or $100,000 sitting at the bank, take 25,000 of it, or maybe take 30,000 of it, and dollar cost average, if it's more than 50, into the market, so that those resources can build up.
I think a lot of folks, and folks, I know Kevin had mentioned that the chat feature seems to be disabled. I'm not sure what's up with that. I hope Sandy's on it. I just sent her a message, but until then, if you got a question, shoot it into that Q&A feature. Just click on the button and type your question there. But thanks for bringing that to our attention, Kevin. I think a lot of people get a little, it's a little daunting when you start talking about these numbers and all the figures. And I know a lot of folks, they might have heard endowment, these types of phrases, maybe in connection with their local university or something like that. But how does that work on the local basis? And you mentioned automatic disbursements or periodic disbursements. How does that kind of work for a congregation?
Great question. So we offer a booklet that is kind of has a workbook in it. There's 18 multiple choice questions in this booklet. It's called our long-term ministry funding booklet. And it's designed to help a congregation decide how they want to approach this. And it does not have to be real complicated with 3 pages of legalese. It can be as easy as you as a congregation, you already have an investment policy. It's put the money in the bank. That's the investment policy.
Yeah. Mm-hmm.
So expand that investment policy to say, money that we don't think we're going to need for 5 years, let's put it in a longer term investment. And so it can be as simple as a structure as that. We don't require 3 pages of an attorney written document. You can create that to be your own police department, to reinforce and enforce all of your rules and regulations. But we don't require that. So an investment account is merely 4 pages. Tell us how you want it invested. We'll answer any questions you have. And, to answer your questions about big endowments that do have the legalese, and we can give you some framework of that. Most big endowments today, if they're taking money out, they're taking out what's called a spending rate. We grew up in an environment where we always think of income as capital gains and dividend. But we've been in a low interest rate environment for 15 years. You can't get any interest. And so what ministries are doing is they're looking at the total return in a period of time, like usually 1 year, and taking out a percentage of that. So when our seminaries and universities are saying we're spending this amount of endowment income, it's using a spending rate of something like 3.5%, 4.5% of the total return, meaning all dividends, capital gains, reinvested, and then the total return at the end of the year, taking out 4% or whatever the process is there. 4% is what we do for for permanent endowments that we're managing for an organization. And the reason NEPC has guided us to do a 4% withdrawal of total return is we wanted to grow beyond the rate of inflation. So if you're taking out 4% of the total return based on 2022 averages, it's based out over 12 quarters, 36 months. It's not just the 22 value. It's based on 2000 and 2001 and 2022 averaged out. That's the 4% withdrawal. And so we can provide sample endowment documents, sample distribution policies, like I just said, the 4%, and even sample gift acceptance policies. You don't want to, perhaps as a congregation, give somebody a charitable deduction for their Precious Moments collection.
That's a big deal.
We can also help, especially in areas like yours, Todd. We can help with gifts of real estate, farms, and businesses. We have staff on hand and a legal department to handle those type of gifts. Great.
That's excellent to know. I think something, and we're running short on time, but one thing that and if you got a question, get it in now real quick before we close. But I know one thing, and this, I'd never thought about this before, and I've been around RSTM. I was, for the last 9 years and before that in rural ministry, and something I had never considered before till one of your former cohorts was doing a presentation for us, who's now retired. He mentioned a scenario where he was working with a particular person on some a long-term planning, and they were doling out funds or setting up funds to go to various folks for different ministry and mission engagements, and his local congregation wasn't on the list. And he said it's because they aren't ready to handle, or they wouldn't be prepared to handle that kind of influx of money. We've got to be prepared. So often we're just worried about what's right in front of our face, and we're not looking down the road. Like you said, if in 1905 Trinity Soulard had thought ahead, maybe there would be a school still there today.
Yeah, you think of everything that's happened since 1905. 2 world wars, Vietnam, Korea, 9/11. There's a lot of history that's happened there, and a lot of those create buying opportunities with the markets. I'm sure that many of the pastors that might be participating in this are thinking of a generous donor during their lifetime that didn't leave anything to the church. Well, it's roughly only 40% of the people are dying with an estate plan. And as Lutherans, as Christians, we should be, thinking about passing on our gifts to ministries as a thank offering of the stewardship that we've had, and create some opportunities along those lines.
Well, and that perpetual stewardship in even beyond our earthly life. What a gift that is to give to the church and ministry. So
When Concordia
folks-
Seminary in Fort Wayne
Go
tell
ahead.
you that you can send students here with nearly free tuition, that's endowment income. That's money that our grandparents and our parents' generation gave, that's been invested for decades. Ministries can have that same feature working for them.
Maybe it'll all work out and Jesus will return tomorrow and everything we talked about today will be irrelevant, but maybe not. So Ralph, thanks so much for being with us today. Great information. Folks, get a hold of Ralph. You had his contact information. If you didn't get that down, go ahead and contact us at Rural and Small Town Mission. We'd be happy to help you out with any questions or getting you contact with Ralph. Thanks to all you folks at the LCMS Foundation. What a great asset you are to our synod and to our congregations and all our membership. Sandy, thanks a lot for all your technical help today. Thanks for everybody getting on and being with us, and all you who will watch this in the future on recordings. God's blessings to you all.
Thank you. God bless.